Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at everything you need to know in 90 seconds at 9 o'clock with news. Aussie banks are bruised today, but far from broken. The biggest international event that affects us is the release of the Hayne report. There are 76 recommendations, and the Australian government is committed to implementing 75 of them. Just as important, the opposition Labor Party has said it will implement all 76. But first, the financial markets will give their assessment in the form of repricing the shares of the institutions covered in the report when markets open later today. Yesterday seemed unfazed by what was to come, with big bank shares rising in price and insurers falling sharply. It seems after the release that today that advance move may become more pronounced. Already the Australian dollar has been unaffected, nor has the bond market prices flinched. Most analysis is what is in the report. Much is as expected and signalled in the interim report issued a few months ago. Just as important is what is not in it. It does not unstitch the dominant position of the big four banks. It is generally complementary of the interim internal moves of reform, especially mentioning CBA as a model, and it does not target the role of the boards. Special negative mention does go to NAB, BNZ's parents, and the lack of contrition shown by its chairman and its CEO. And some banks and senior managers may face criminal charges and prosecution on specific technical matters. Also, it leaves in place the responsible lending criteria adopted by the industry, as well as the household expenditure measure for assessing mortgage affordability. These are important because it doesn't try to force more regulation into credit assessments, leaving this as the risk and responsibility of the bank credit function. Despite this, it is clear more prescriptive oversight is in the bank's future, even if the regulators haven't covered themselves in glory in this review. However, the report is particularly scathing of the inherent conflict of interest that brokers have in the system and the way they are paid by commission. It fingers brokers working to defraud bankers. First, Sedgwick and now Hayne have called out that indefensible structure. Oddly though, this is the one recommendation the Australian coalition government is suggesting it may not implement. Brokers have political influence, it seems. How that aspect plays out in New Zealand will be interesting to watch too. We'll have a more detailed review of the report as it affects New Zealand later today. In other news, US durable goods orders fell in November for the second month in a row. A double fall like this is rare. They are, however, up 3.7% year on year. More importantly, capital goods orders fell year on year, however. In China, the president is finding it increasingly necessary to reassure everyone who will listen that the future of the country is bright. And the US-China trade negotiations continue, unresolved ahead of their March deadline. No one really expects anything more than encouraging words at this stage. UNCTAD, the UN trade organisation, however, has modelled those US tariff increases and finds they will shift trade sharply, and the US is likely to lose trade share. But there will be other winners, and when they say more than 80% of the benefits will be captured by firms in countries other than the US. Asian equity markets with little change in trading yesterday ended up mildly positive, even in Australia. Today, Wall Street is continuing a trend, even though EU markets were somewhat lower. And back in Australia, the housing market is still being roiled. The number of new dwelling consents dived in December, fanning fears the housing slump will drag into their economy. They fell an eye-watering 26% in December compared with the same month a year ago, and their lowest in 5 years. For all of 2018, the decline was 5.6% compared with 2017, although the number of houses consented was flat. The biggest falls were in the apartment sector. US Treasury 10-year yield is higher today at 2.73 and a gain of 5 basis points from the end of last week. Their 2-10 curve is also higher, up to just under 20 basis points. Gold has drifted lower overnight to $1,314 an ounce, a $3 shift down. And US oil prices have moved lower today as well, to just over $54 a barrel, while the Brent benchmark is just on $62 a barrel. Both are slips of about $1 a barrel. And the Kiwi dollar will open today at 68.8 US cents. On the cross rates are at 95.3 Aussie cents and 60.2 Euro cents. That leaves the TWI at 72.9. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.